Okay, good morning, everyone. My name is Raluca Roman. I am an economist at the Federal Reserve Bank of Philadelphia. It is my great pleasure and honor to be your moderator for the first segment of the conference today. I would like to extend a warm welcome to all of you to the fifth workshop on credit card lending, consumer finance, and the AI revolution. And just to let you know, this is hosted by the Federal Reserve Bank of Philadelphia and the Supervisory Research and Policy Forum, also known as SURF. We have an exciting lineup of keynotes, research papers, and panel discussions featuring experts from academia, regulatory bodies, and industry-leading organizations. This morning, we'll explore cutting-edge research in consumer finance, examining risks and opportunities across innovations in credit card payments, payment networks, fraud, and open banking. Please note that all attendees will be muted during the broadcast. We encourage you to use the Teams chat to submit your questions throughout the conference today. And we will select questions from the Q&A for the Q&A sessions from those submitted by you in the Teams chat. Without further ado, it is my great pleasure and honor to introduce Bob Hunt, Senior Vice President and Associate Director of the Consumer Finance Institute at the Federal Reserve Bank of Philadelphia, to get us started today with the conference. Thank you so much. Bob, the floor is yours.
Good morning. I am Bob Hunt. I am the Associate Director of the Philadelphia Fed's Consumer Finance Institute. And together with Rock Armanter and Julia Cheney, we manage a bank-wide interdisciplinary initiative of investments in data, technology, and technique to advance research, policy analysis, and education on topics related to consumer finance. And on behalf of the Philadelphia Fed and the conference organizers, especially Jose Canales, Roy Nilam, and Raluca Roman, I am pleased to welcome you to this, our fifth workshop on credit card lending, consumer finance, and the AI revolution. I also want to say hello to so many of my friends and colleagues who are participating in today's event, and so many of you I hope to meet for the first time, even if we're limited to just 2 dimensions. Before I go further, I want to invoke a universal disclaimer for myself and all Federal Reserve staff. I'm sure there's a comparable disclaimer for members of the other supervisory agencies participating today. These are my views only and not those of the Philadelphia Fed or the Federal Reserve System, and nothing I should say should be construed as legal advice, nor should our remarks be construed as an endorsement of any organization or its products or services. As is custom for this event, today's open conference is followed tomorrow by a regulatory roundtable in which members of various financial regulatory agencies will participate. This roundtable is jointly organized by the Supervisory Research and Policy Forum, the Office of the Comptroller of the Currency, and the Federal Deposit Insurance Corporation. Now, while you may be familiar with the OCC and the FDIC, you may not be familiar with SURF. This is a community of regulators, policymakers, and subject matter specialists in retail credit and the supervision and regulation of banking institutions. Through events such as this one, SURF fosters dialogue and socializes insights based on a rigorous understanding of the data to improve our understanding of emerging issues in the supervision and regulation of financial institutions as it relates to consumer credit. The key, as you may have already gathered, is to bring together a diverse group of perspectives and to participate in difficult conversations about the issues of today and tomorrow in consumer finance. And to do that, we need all of you. We need practitioners in the marketplace. We need academic researchers and analysts, supervisors and examiners and policymakers, consumer advocates. This is what we do here at the Philadelphia Fed, and this conference is an excellent example. We must be doing something right. If you attended our 2022 conference, I hope you came away thinking it was perhaps the premier event of its type to promote these conversations and collaborations. And as I reviewed this year's agenda, I'm truly impressed by the choice of topics and the caliber of presenters and panelists. Without doubt, this will be the best in our series of conferences so far. And if you're listening to me now, you probably agree. Indeed, with this year's fully virtual format, we have about 800 people registered to participate, and that's an amazing number in my opinion. With the remainder of my time, I want to touch on today's agenda and take a few moments to reflect on the issues and the marketplace as it has evolved since we last met in December of 2022. We will begin with a keynote address by Professor Sumit Agarwal. It is not an exaggeration to say that over the course of his career, Sumit and his co-authors have profoundly changed the academic literature on consumer finance. This is no small feat in a literature that has advanced by leaps and bounds since I became interested in the field a quarter century ago. Another interesting observation about Sumit is that in addition to his long career as a professor, his background as a credit risk practitioner, a Federal Reserve researcher, and as a consultant to numerous government agencies around the world, he embodies the communities we aspire to assemble today. Sumit's remarks are followed by 2 sessions consisting of 4 presentations on important topics of the day in consumer finance, and especially for credit cards. In a few words, these include the efficacy of behavioral nudges, antitrust issues in payment networks, fraud, and open banking. These are followed by a panel charged with a forward-looking discussion of the future of consumer finance with perspectives from around the world. Having got through the easy stuff, we'll break for lunch and fortify ourselves for a multifaceted discussion of topics in machine learning and artificial intelligence. We begin with another keynote address on the topic of trust from the vantage point of one of the organizations attempting to deploy new tools in the marketplace. This is followed by 2 sessions consisting of 4 presentations, again on the important topics of the day in this field. In a few words, these consist of large language models, generative AI, differential privacy, and emerging developments. In turn, these presentations are followed by observations from a truly diverse panel representing industry and academia. Jose will close today's event with his own observations. It's worth taking a quick look back at the agenda from the previous edition of this conference 18 months ago. At that conference, there were also examples of research on behavioral nudges, welfare implications of credit card pricing, in that case, rewards, and other innovations, including buy now, pay later. There were several panels on machine learning and artificial intelligence with a very specific focus on different ways in which more fairness could be explicitly engineered into the innovations entering the market. So one observation is that many of the topics we're discussing today seem to have legs. Now, taking a step back from the perspective of the economy and the market, what has changed in these 18 months? In December of 2022, depending on your preferred measurement, we were just experiencing the peak of the inflation rate. This was followed by a somewhat inconsistent disinflation that we're still experiencing. Large increases in personal income and cash reserve, much of it the result of fiscal stimulus that had occurred prior to 2022, was beginning to be eroded by this inflation. The large decline in credit card balances had reversed and begun to rise rapidly on a year-over-year basis. Indeed, that growth rate peaked at the time of our last conference and has gradually decelerated since then. Interest rates have been rising for most of the year prior to that conference and continue to rise for another 6 months. The result is that the average interest rate on non-promotional accounts has never been higher in the administrative data available to supervisors. Lenders had already begun to tighten their underwriting criteria by December of 2022. And while this had relatively little effect among applicants with prime credit scores, it contributed to a significant fall off in new accounts and credit lines for subprime applicants. This, combined with the increase in balances I mentioned a moment ago, has resulted in utilization rates on credit cards among subprime borrowers that have not been seen since the end of the great financial crisis. And it is safe to say that in terms of unused revolving lines available to subprime borrowers, there's little dry powder left. At the time of our last conference, delinquencies on credit cards had been rising for about 18 months, albeit from historically low levels. In December of 22, they reached about the same level as they had been just prior to the pandemic. And they've kept rising so that today they're as high as last seen at the end of the great financial crisis. With some delay, the charge-off rate has increased accordingly. Consumer bankruptcies, which fell by half during the pandemic, began to rise just after our last conference, although they're still well below the pre-pandemic rate. On the other hand, the most fortunate for both consumers and lenders, the labor market remains strong and resilient. Had this not been the case, the clouds I've been describing would be even more concerning. And so my final observation is that while much of today's conference is a longer-term, forward-looking conversation about innovation, it is happening in the context of a very different point in the credit cycle than when we last met. And I'm sure this will be apparent in the conversations that we will have today and tomorrow. And with that, I will turn back to Raluca.
Thank you very much, Bob. That was very inspiring. And now we are going to proceed with the keynote address by Sumit. We are very pleased and honored to have today our keynote speaker, Sumit Agarwal, the Low Tech Kwong Distinguished Professor of Finance, Economics, and Real Estate at the National University of Singapore. Sumit is joining us today from Singapore to share his insights on the future of the credit card market. Sumit, thank you for being here, and the floor is yours. Thank you.
Thank you, Raluca. Can everybody see my slides?
Yes.
Okay. Yes.
First, thank you for inviting me for the 5th workshop on credit card lending, consumer finance, and the AI revolution. I want to thank Jose and Raluca for putting together this great conference and starting out with me. So I have a lot of pressure on delivering on this thing. So today what I want to do is talk about credit cards and consumer behavior. So this will be kind of looking back at a lot of the research I've done over the last 25 years on the credit card market and how consumers tend to use credit cards. And then I will spend maybe around 20 minutes talking about the challenges that we see, or at least I see, in the credit card market and the opportunities that bankers should see in this. As I understand, there are regulators, there are academics, and obviously there are industry people. I was in the industry. I worked on credit cards for 25 years. As a banker, as a regulator, and now as an academic. So I have this perspective of looking at the credit card market from various different dimensions. So I'm going to talk about that. So obviously the credit card world, or the credit card usage, has been going up. Now it stands at around 6.8 billion worldwide. Credit card usage has gone up quite a lot. This is just looking at data from Visa and MasterCard. So credit card, you would think they're slowing down, but clearly the adoption and usage of credit card has been going up. So the argument in household finance has been that all consumers should be using credit cards as transactors instead of using debit cards, wallets, cash, or any other means of payment, because credit cards offer unique benefits, free float for 30 days, various rewards and perks. Transactions are insured, you get cash back. But the problem is that a lot of consumers who were supposed to be transactors end up being debtors or actually carrying on debt. Right now, credit card debt stands at around maybe $1 trillion plus. US per person credit card debt is over $5,000. Many other countries around the world, you can see consumers having significant credit card debt as well. So with that background, academics have been saying that, look, maybe consumers are just not prepared to make financial decisions in this increasingly complex financial environment. You can take many, many examples: Social Security privatization, 401k under participation. Let me go to the last one. Credit card fees and APR interest rates are very high. And as a result, what we should do, should we actually have credit card usage, or should we let it go up? Obviously, credit card industry has been doing fairly well in this environment. The amount of interest accumulated, or interest revenue, that the credit card companies has been generating over the last 20 years is the largest revenue for the banks. When I was working early on, there was this classic example I had looked into where one bank was advertising 3,000 different kinds of credit cards. So it just makes it very daunting for any consumer to understand how to choose the right credit card. So, people have been arguing that consumers may make wrong choices. As a result, they incur very high interest rates and fees. And others argue that maybe intermediaries may be at fault because they are accessing excessive rents from their consumers. And as a result, maybe we should think about financial planning, financial literacy, financial education for the households before they can get into credit markets. So I'm going to spend the next few minutes talking about some of the studies I've done with my co-authors around the world, looking at consumer credit and how people have used specifically credit cards, and do they make mistakes? As I just was pointing out earlier, maybe consumers are making mistakes. Okay, so we long time ago, we had looked at this, a very simple experiment. This was work with Nick Solelas by offering consumers two different credit cards, where the credit card one, they could choose a very simple interest rate of 12% with an annual fee of $20, or another credit card with an interest rate of 15% and no fee at all. We also said the consumers can actually switch these cards at any time. So clearly the optimal choice for any consumer would have been that if they were expecting to borrow, they should choose credit card one. And if they're expecting not to borrow, they should choose credit card two. So sounds like very obvious choice. But when we looked at the data, strictly speaking, 40% of the consumers, or 43% of the consumers, actually made the wrong choice in picking the credit card. So what I was saying earlier on, consumers are ill-prepared in making financial decisions, especially in consumer credit. This kind of validates. We were looking at a sample of 150,000 consumers in the US. So 40% got this wrong. The good news from this chart was that as the cost of making the mistake got higher and higher, which means as the cost got to around $200 plus, a very tiny fraction were actually making this mistake. So I just want you to keep this in mind. Well, consumers do make mistakes, strictly speaking, in choosing a simple credit card offer. Since I mentioned that they could easily switch their credit card, what we thought that most of these consumers will actually get it right eventually and switch to the right credit card offer that they want. Only 3.8% of these consumers actually switch credit cards. So that was kind of dismal. That look, they had this option, but they never took on it to get into the right credit card contract. Next, I want to present some other study I've done where we wanted to see if consumers learn over time how to deal with credit cards. This is about paying credit card fees, late fees, over limit fees, cash advance fees on their credit cards. Typically, when consumers start out having a relationship with a bank, they end up paying a lot of fees, all these different fees. Remember, this data we were using was pre-Card Act, so we were looking at all the three different fees. Subsequently, we know some of these fees have been removed. But what you actually see in the data that consumers start out paying a lot of fees to the bank, but over time they learn, and in a period of 5 years, this relationship, they actually pay very little fees. So there are two things I can point out. A lot of consumers make mistakes, but over time, these consumers learn from their mistakes and actually do better. Now, the same mistakes will hold true. I have data from post-Card Act from both US and other countries, and I've looked at the data, and consumers make the same mistakes. So I can repeat this study using data from 4 years ago or 2 years ago. You will see very similar patterns. The next point evidence I want to show is who is typically making these kind of mistakes in consumer contracts, especially in credit cards. You can think about, you find that the young and old people tend to make more mistakes in actually picking any credit contracts. You could look at credit card contracts, home equity loans, home equity lines, or anything. And it's kind of puzzling. Why do young and old people tend to make suboptimal credit card contract choices, where the middle-aged group tend to do much better? We have replicated this study across different credit markets, and I've replicated this study across countries, and I find very similar evidence that young and old tend to make consumer credit mistakes. So the preferred argument I have for consumers making mistakes is age-related cognitive effect. And what I will try to argue is that as you age, your cognition declines from age 20. So essentially, for most people in the room, you are actually on a declining part of your cognition. And by age 80 or 90, you're almost 2 or 2.5 standard deviation where you used to be when you started out at age 20. But similar at the same time, experiential capital goes up. You gain in experiential capital. So there is this kind of an inverted U-shaped pattern where you make the best decisions. So when you're young, you have a lot of analytical capital, very little experiential capital. When you're old, you have a lot of experiential capital, but very little analytical capital. So in some part of the age distribution, in the paper, we document that age is 53. Right now, I'm 54, so I've just passed it. So I'm on the declining part of my financial decision making. Okay. So then I wanted to study next is clearly cognition plays a role. Then can we study if cognition is directly related to financial decision making? And if this evidence is there, then the argument for financial literacy, financial education, financial counseling becomes much stronger. So here, what I was looking at, balance transfer mistakes on a credit card, when you actually, what people in the industry will call rate surfers, they will typically use one credit card, have debt on it, then immediately turn to another credit card, which is at a 0%. And this helps them kind of reduce their debt payment. So typically the balance transfer, the way it works is you have debt on credit card A, you get a teaser rate on credit card B, you just move your debt. But a lot of consumers forget that there is this thing that we will apply your payment to balances with lowest interest rate. Now, some of these issues are not there subsequent to the regulatory changes in the US, but in other countries, these facts still are there. So even if you walk away from the US, you look in other countries like India, China, these regulations still, is still applicable, and consumers still fall prey to the fact that they don't actually know optimally how to switch credit cards. And even if they switch their debt from credit card A to credit card B, they may continue to use credit card A for future purchases. And then any payment they will make on credit card A will be applicable to the balance transfer debt versus anything else. Okay, so the idea is very simple. I just explained it, how this balance transfer mistake works. Here is the kind of a walk down of it. If you have two credit cards, you transfer the money. You should not use the credit card where you have transferred the money to, because if you use that, then any payment you will make will be used towards the debt, not to your current spending, and you will start incurring new debt at 24%. So I wanted to look at who are the people who make this balance transfer mistake. So I correlated with this credit card data, a data set of US Army personnel who have taken an AFQT score. This is the Armed Forces Qualifying Exam score that measures your IQ. It measures your math score, your cognitive scores, your linguistic scores. So they have around 8 or 10 different scores that they measure. So we match these through data sets using a very unique identifier. And then I wanted to study, once you have this data set, who are the people who are going to make these credit card balance transfer mistakes? So here is a simple graph that kind of does this correlation. On the x-axis, I have these people's AFQT scores, which is you can think of this as an IQ test. And on the y-axis, I have the number of people who are making mistakes. So you clearly see that people who have very high IQ scores, they tend to really understand right away that, look, I don't want to make this balance transfer mistake. I understand how this works, and I will start using credit card A from where I've transferred my balance to credit card B, where if I touch that, then I will actually be incurring debt at 24%. But if you go down the scale of AFQT and you start looking at scores that are between 0 and 60, those are the people who do not understand this eureka moment or tend to make credit card mistakes. So you can think about these few studies are kind of showing that consumers do tend to make mistakes. Here is another study. We were looking at peer effects in consumption. There's a big literature on peer effects, which shows that, why do people smoke or get into sexual activities? We want to study if consumers actually, their consumption behavior is determined by their neighbor's consumption behavior or lack of their consumption behavior. So here we were looking at a shock within a given building in Singapore. And if somebody declares bankruptcy, we wanted to study what is happening to their neighbor's consumption behavior. And then we were looking at what is happening to the neighboring buildings around there. Here is a simple regression result that the consumption of the people who live in the same building on average drops by 3.5% as measured by their credit card usage. So this was a large sample. One person in the building got a negative shock because they declared bankruptcy, and everybody else in the building. In the paper, we document the mechanism. We go into a lot of details. But here I'm just kind of showing you the big picture that actually our consumption behavior is not determined by ourselves, but also what happens to our neighbors. So all these studies kind of tell me consumers tend to make mistakes. And here I was purely trying to study the credit card markets. I've spent a lot of time, last 25 years, actually not just studying credit card markets, but actually looking at credit card spending and due to various policy shocks. Okay, so for example, looking at fiscal shocks that could be like tax rebates or tax increases in Singapore, tax rebates in the US, tax subsidies in Singapore, looking at monetary policy shocks, inflation targeting in India, or monetary policy rate hikes in Turkey. There are lots of macroprudential shocks that you can study, and using credit card data, understanding how actually consumers behave in the consumer credit market. Here we had looked at some liquidity constraint on credit card holders in Turkey and also in Singapore. And I have some work with Raluca and others looking at how stress tests across banks in the US affects their consumer credit usage through their credit cards, both from the demand and supply. I've been studying the credit card markets for 25 years, so I have lots and lots of work on this topic. Clearly, I will not go into them, but there are lots of interesting questions you can study. For example, we wanted to study if through credit cards, consumers or banks can actually give credit card offers to bureaucrats in China and use that for kind of doing quid pro quo in terms of corruption, giving them higher credit lines, letting them default on their credit lines, and reinstating those credit lines. And you can see how actually this works in a very nice setting that we study in China. I've looked at GST reform in India and how consumer credit usage after GST reform in India has actually changed. So far, what I have kind of discussed is what has happened in terms of consumer credit research and consumer behavior around the world using either credit card data or broadly consumer credit data. Now let me spend a little bit time talking about the challenges that I see in the credit card industry and then the opportunities that I see in the credit card industry. In terms of the challenges, in the credit card industry, the biggest challenge I thought was after the financial crisis and the Card Act that came about, and the Card Act actually removed the over-limit fee that caused significant losses for the credit card industry. There is a paper in which we actually document this very clearly what happened. But obviously, the credit card industry is still flourishing, doing fairly well. Interest rates are still quite high. Debt levels on the consumer credit is still quite high. The second big challenge, which I think people in this conference will be talking about, is the fintech revolution. Now, the e-wallets, while in the US may not be a big deal, but around the world, if you are actually in China, I was recently in China, you cannot use any other means of payment except some form of e-wallet. they are really taking away business from the credit card industry. If you go to India, after demonetization, the e-wallet market has also grown there quite significantly. So I have looked at this in the context of Singapore, and here is some evidence that I have showing how the e-wallet market, the introduction of an e-wallet affects businesses, affects consumer credit, and affects banking behavior. So in Singapore, they introduced this QR payment technology. Essentially, one of the largest banks in Singapore, which is DBS, they said, we will use this idea, we'll introduce PayLah. Now, you can think this is not that simple because it's a two-sided market. There are three players. There are banks, there are merchants, and there are consumers. Obviously, the merchants prefer e-wallets and they prefer cash because e-wallets helps them reduce cost. Credit cards have significant cost for merchants because they have to pay 2% fees for using these credit cards. Banks actually prefer credit cards and they prefer e-wallets. Consumers, on the other hand, may prefer all three. They may prefer cash at sometimes because they may want to hide some transactions. They may prefer e-wallets because it's easy, but they also like credit cards because it's a, as I started out my presentation, it's a very good means of payment. You earn rewards and you earn many things through credit cards. So it's not clear what will banks do, what will the merchants do, and what will the consumers do when you introduce a QR code-based payment technology. What we actually looked at massive amount of data on small business usage of the e-wallet technology in Singapore, and we find that after the introduction, the small merchants really benefit from the e-wallets, and the sales in the small merchants goes up significantly. Large merchants don't benefit as much because a lot of their customer base is already using payment technology like credit cards, but the small merchants, they were using a lot of cash, and people transferred away from cash and started using e-wallets. There was a drop in credit cards also, but e-wallets the cash drop was the biggest effect there. Then we also looked at what was happening because of this technology, what was happening to new business creation, especially small business creation in Singapore. Clearly, this had a huge effect, not just on the intensive margin, which is the sales of small businesses going up, but the creation of new businesses. So you can think about the introduction of e-wallets will help a small business creation, will help consumption and spending at small businesses. Now the credit card industry needs to think about how do we position ourselves in this market where we are bringing in new technology so that we don't lose a piece of our pie. We kind of displace cash, whereas people move away from cash using e-wallets, but credit card usage continues to be as it was. So here, this was a case study where we wanted to document that how this transformation happens between cash, e-wallets, and credit and debit usage, where we do find some drop in credit usage. But I think over time, if the banks position themselves right, they can regain the market share in the credit cards. Now let me talk about some of the opportunities, I think, in this market. So I will talk about three different opportunities for the credit card industry in going forward, the way I see it. The biggest opportunity I think about is around the world, I'm noticing there is adoption of digital payments. Not just e-wallets, but digital payments, because countries want to kind of diminish the use of cash. We see this in Scandinavia. If you go to China, essentially, if you have cash, you really can't use it. Just anecdotally, I was in China a few months ago. I was at a restaurant. I was trying to make a payment using cash, and the restaurant plain and simply told me, we don't take cash. Luckily, there was somebody sitting at a table near me. I paid them cash, and then they used their e-wallet to pay for me using their WeChat account. So clearly, digital adoption is happening in most developing countries, but also developed countries. So the question is, how is the credit card industry can take advantage of it? Instead of this digital adoption going to wallets, can it also go to credit and debit card transactions? So here is a simple picture that kind of shows you how much digital payments have kind of come about just in a period of 3 or 4 years. So we actually looked at this in a study I did in India, where we actually showed that what will happen to digital adoption. Now, it's very difficult to study digital adoption. So we looked at a natural experiment in India where there was demonetization, which means 90% of the cash in India was removed by the government because they thought there was various reasons the government gave at that time. There was a lot of corruption, black money, and so on and so forth. Hence, we will demonetize the current currency and will introduce new currency. That obviously created huge problems for the banking system, but it gave me a very nice setting to study when you take away cash, essentially, what will happen to usage of other means of payments, especially digital payments. Here is a simple graph that kind of shows you what happens when you actually remove cash. The top line was the cash usage, which was used to be at around 80% before the demonetization. It went down to around 50%, but eventually came back up slowly. At the same time, what you actually see is debit card. In India, the credit card penetration rate is not very high, but debit card market actually took off quite significantly at that time. Over time, it came back, but it has still not gone back to the same levels. So the question is, can we capture some of the market share of cash away permanently through digital payments in these countries? So I'm using this setting, but if you look at other countries where we are seeing reduction of cash naturally, either because merchants or banks actually say we will not allow you to use cash. For instance, in Singapore, the number of ATM machines that used to exist has gone down by half. And the argument is that, look, these are costly. People are not using them. They're using digital wallets or they're using more electronic transactions. So why are we having ATM machines? That's another way to say we are going to take away cash and let's see what consumers do. There's some studies that have looked at removal of ATM machines and what has that done to evolution of electronic payments. So in this slide, what I'm showing you in a kind of a setting comparing people who use a lot of cash versus people who use less cash, what is happening to their spending after the demonetization exercise. What this is showing is that consumers actually tend to spend more money after they adopt digital payments. Let me say this again. It's not that the consumers are switching to digital payments. They are already switching, which I showed you earlier, but their overall spending is going up for the next 12 months, at least in the data that I can show you, but perpetually, because the pain of paying by cash that you experience is not there when you pay digitally. So when you pay digitally, you don't have that pain, so you tend to actually spend more. Cash usage is down and your spending is up permanently after doing this. So the lesson I take away from this is thinking about what can the credit card industry think about. The more we remove cash, the more we go digital. Part of that pie has to be going to debit and credit cards. And I'm documenting that consumers tend to actually spend more. So the question is, then how should the credit card industry position itself or debit card industry to take this share? Now let me talk about two other ways the credit card industry can capitalize, I think, going forward. In the past, the credit card industry has been using the credit card spending and payments data to detect fraud, delinquencies, consumer demographic trends, consumer behavior. And the typical data that the credit card industry has used is the monthly statement data. They have actually looked at the statement dates, looked at what the state from the statement dates, when you are making the payment, what kind of dates you're making the payment, how close you're making the payment to the due date, and they use that to understand attrition, delinquencies, and fraud. They have also subsequently migrated about thinking about using other data, which is the transaction level data. There they have created a lot of spending categories. If you're a high spender, if you spend on luxury items, what is your spend on travel, what is your spend on groceries, and so many different compartmentalizations. And they've been providing this information both to merchants and also to consumers to help consumers learn about their spending habits. So this has been a great thing by using both the statement data and essentially the transaction level data to help the consumers. Well, what happened to my slides? So what I want to think about is, can we go a step further? Can we think about using receipt level data? So what do I mean? Like, once there is a transaction that happens, imagine you going to a restaurant. At a restaurant, you eat 5 different items. Those 5 items are listed in a receipt. The way the restaurant works, they actually have 2 different systems. There is a inventory management system that actually takes these receipts and processes it. Then the inventory management system says, okay, these 5 items were eaten. As a result, we need to think about replenishing the inventory that went into making these five items. And then there is a system of processing the payment. So the payment processing goes through Visa or MasterCard, and the Visa or MasterCard does that. And then the consumer at the end of the day actually ends up with 2 different receipts. One is a receipt of the purchases they made either at the grocery store or the restaurant, and a receipt of the payment they made. I'm thinking, why shouldn't Master Visa be in this business of actually providing the receipt or processing the receipt for the merchant or the grocery stores themselves, and taking on the business of inventory management or providing free inventory management to these merchants? They can also help their consumers because now they know a lot of information about the receipt level data about their consumers. They can provide them this information on what kind of products they use, when should you actually replenish your inventory, both to the merchant and also to the consumer. I see a big win-win for the consumer, for the merchant, and also for the credit card industry at large by taking these receipts, consolidating into the payment platform, and helping the consumers and the merchants. I can imagine. I mean, I've had these conversations with bankers in Singapore and India, and they clearly see the value in it. They said this is a very good idea. I mean, obviously, it's not simple to execute. There could be some privacy concerns. The fact is, you're already, when you go to eat at a restaurant, the merchant already knows information of what you ate. And they most likely are already selling this data to other vendors. When you go to a grocery store, they already know what you're buying and the details of these the receipts. But you can consolidate that. It can help you as a consumer because now I don't need to carry all these receipts. It's already in an electronic form. With my credit card company, I can just go down anytime and look what are the products or what are the food items I bought or I ate at any given time. I mean, I see a big win in this. Okay, so my argument is, why not collect all this kind of detailed consumer credit, consumer data, incorporate that. Okay, the receipt can help the customers with reminders about their own inventory management. The data can also be potentially used for detecting fraud and also for marketing. I mean, one thing I've always baffled with is recently I was just in Cyprus last week, and I bought my ticket using my credit card. So clearly the credit card company knows that I have bought a ticket to go to Cyprus, but then as soon as I was doing transactions in Cyprus, they blocked my card and they said, oh, we are detecting fraud. All the data exists for you to know there's no fraud because the ticket is bought from that card. Or you should have blocked my credit card when I bought the ticket because you should have thought somebody else is trying to go to Cyprus. I'm saying you can do this fraud detection and things even better if you actually have this receipt level data as opposed to purely just transaction level data. Let me point out my last point, which is how else can credit card companies use this data? So we have seen that over the years, the FICO score has been a very good measure of consumer vulnerability or consumer credit, how good consumers are in their credit usage. I would think, why not go one step further? Why can't credit card companies or banks think of building a carbon scorecard for their consumers? The way I have analyzed, I run an institute at NUS that talks a lot about green financing and sustainability. And from a consumer point of view, so my take on this institute has been about household sustainability. And from a household point of view, when I think about sustainability, their footprint is in food, transportation, and utilities. Most of these payments that consumers make towards their transportation needs, if they're putting in petrol in their car, if they're taking mass transit, if they're using Uber or any other form of transportation, all of those transactions are listed on their credit cards, debit cards, or such electronic means of payments. Most of their food transactions are also in their electronic payments. And utilities, am I paying for my gas, my water, my electricity? So all of this data you can think about is already being captured in the electronic data sets that banks have. Banks can then just take this. Now I already talked about the receipt level data. They can actually enhance that and actually know what kind of food the consumers were using. So they can really use a lot of the data that they have to construct a very nice scorecard for their consumers. I want to call it a sustainability scorecard. You can call it a carbon scorecard, whatever you want to call it, but you can build a carbon scorecard. Now, why is this useful? This will be very useful for the consumers. You can actually tell all your consumers, this is a scorecard that we have built for you. You know, based on your information, where you lie. They may not want you to make it public. That's perfectly fine, but at least you can provide a service to your consumers. Why am I saying this? Because banks in Asia, in Singapore, in China, in India are already moving in this direction, trying to build a sustainability scorecard using the data that they're collecting. At my institute at NUS, we already have built a scorecard, like a sustainability scorecard, using the data from their financial transactions that we have collected from the banking records. So I think this is potentially a very good use of the data that the banks can collect going forward and provide a service to their customers about a sustainability scorecard. So I spent some time talking about some of the opportunities, some of the challenges that I see going forward for the credit card industry. Actually, I'll stop here. I have another 5-6 minutes, so I'll just take questions if some people have questions on some of the points I've raised. Just the starting point where I was talking about consumer behavior, how consumers make mistakes in the credit card market, and then going forward, how I see how banks can take advantage of the opportunities that they see. Thank you very much.
Thank you very much, Sumit. Very inspiring. And we really appreciate your time and the valuable insights today. I'm going to read to you a couple of questions that we received. One is, do you see any concerns with consumer privacy related to the use of additional data? Sorry, 1 second here. Yes, by financial companies. And then
Yes, I mean,
please, yeah.
Obviously this is an issue. I mean, I started talking about privacy and misuse of data. I want to be very clear that look, when FICO score was created, similar questions came up. That look, you're creating a FICO score, you're sharing all this data. What will happen to my privacy? But we created safeguards around the world on making sure Fair Isaac was not misusing or abusing this data they were collecting, or banks were not doing such. Clearly, we can think about creating a sustainability scorecard or a carbon scorecard and making sure that the privacy is restored and protected. And if consumers want to opt out, they should, and they can easily opt out and by saying, please don't use my data and I don't need to know my score. My first goal is not just to go out and sell this score to everybody else, but just to create the score by the banks for their consumers so the consumers can benefit and understand where in the scale of a carbon scorecard do they lie, and can they change their own behavior based on their own data to kind of reduce their carbon scorecards if it benefits them.
Thank you so much, Sumit. Another question. We are obviously living in an AI revolution nowadays. And I was wondering if you have any suggestions on how maybe AI could be used to improve credit card usage and also improve financial decisions by consumers. You talked a lot about financial mistakes made by consumers, but can we use the technology today to improve that? Thank you.
Yes, clearly, I see a lot of value in AI actually being part of the toolkit that consumers have. It could just be an application on their phone that allows them to consolidate their spending behavior, their payment behavior, understanding, or even guiding them what kind of consumption is optimal at this point based on the budget constraint that the consumers may have. Okay, so I can see that AI becoming a very important tool in the consumers or households decision-making toolkit. This is the right time to make the payment for this credit card. This is the right time to make your mortgage payment, and so on and so forth, based on your income statement, based on your other debt repayments that they have to do.
Thank you so much. Another question. How can e-wallets and other virtual spending behavior consolidation further impinge lower income consumers, especially those who cannot easily afford to engage with the digital aspects of society? Thank you.
Yeah, so that's a concern. I mean, I thought this would be a big concern when I went to China. I thought there would be huge disparity among the Chinese, especially if you think by age. If you're an older cohort, you don't really use technology as much, or you're not used to using your smartphones. And so how are they coping? But you will be surprised. I mean, in China, pretty much everybody knows how to use their smartphone or their phone to make make payments using this. So I think we think too much that this will create problems. But I think once people are thrown into it, they will use it. After demonetization, I thought in India, what will happen when you took away 90% of the currency? Will consumers be able to cope with it? Consumers immediately switched over to e-wallets and debit and credit card transactions very quickly. They came back to cash because, there is obviously a lot of corruption and black money, so they prefer to use cash. But people did adapt very quickly.
Thank you so much. One more question, again, related to data privacy, I think. Again, we have seen hacks into systems, including major software vendors. Are you concerned with the collection of this data being accumulated by hackers or intrusive, oppressive governments? Thank you.
Yes. I mean, look, broadly, I agree with you. I have recently written a paper. It just was published. I didn't bring it up in my talk, though, that we actually looked at data hacks and data breaches of consumers. And then we looked at consumer spending behavior and usage behavior of the same app and the same method of payment versus other methods of payment. You know how long consumers stop using those means of payment? 2 weeks. And they completely forget about it because they really like using the apps and they really don't care about what data breaches or happen at those companies. So while I think it's true that some consumers do care, but vast majority of the consumers in the data, at least I can't find that they care a lot about their data being stolen or data from a company being stolen.
Thank you. And one last one, and I think then we end. How can you incentivize banks, lenders to come up with carbon scorecards? Thank you.
You can do many things. So one thing you can do is the way right now banks actually have a mandate to do green financing. Most of the green financing that the banks are doing is to corporates, but they don't understand there's obviously greenwashing that is happening in the corporate world, and so they're giving credit to corporations which potentially are doing greenwashing. Instead, they could give credit to consumers if they have very low carbon scorecard. And this is one way for them to show, look, we are doing green financing and we are not doing greenwashing because we already know the scorecard we are calculating about our consumers, and we are providing them lower mortgage rates, lower credit card rates, lower rates on their auto loans, and so on and so forth.
Thank you so much, Sumit. And it's been a pleasure having you here today.